Hello, I'm Greg Bell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, markets are showing resilience, uncertainty lingers. We're going to hear from veteran trader Jonathan Corpina in just a few minutes' time. We're going to hear why falling volatility over the past 24 hours may matter more than the market's move. Plus, with earnings season ramping up, we're going to find out what he's watching most closely. And in today's technical take, we're taking a deep dive into big tech and the signals that traders are tracking for what comes next. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. A little more than half an hour into the trading day. We had a nice bounce back yesterday after the drama of earlier in the week, and we're building on it today. It is modest out of the gate. There's some sort of deal around Greenland. We don't really have the details, but we do know that President Trump is walking back the tariff threat. The market seems to like that. Can perhaps start to look at some other things. Want to jump into the heat map and see where the action is today. We can see a lot of the tech names are putting points on the board. It's not a huge jump higher for NVIDIA, Apple, Google, and the Microsofts of the world, but it is green, it is not red. I want to take a look at Mobileye Global, maker of autonomous vehicles, self-driving cars. Their full-year guidance disappointing investors. It's not about the quarter behind them, but what is to come. They're expecting revenue a little shy of consensus. It's more on the adjusted operating income guidance they're giving us, far lower than the street was expecting. And you can see we had a bit of a swoon out of the open, but maybe investors are starting to look past it because the stock is starting to make some gains off of the bottom right now. So I got to keep an eye on the markets. GameStop, I want to show you this one too. The CEO and chairman, Ryan Cohen, snapping up 500,000 shares of the video game retailer on Wednesday. That's after purchasing 500,000 shares on Tuesday as well. You get a little bit of insider buying. Of course, this is the ultimate meme stock if you go back to the days of the pandemic, and a bit of a boost for the name today on that news. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team, and from New York, we're joined by Jonathan Corpina, senior managing partner with Meridian Equity Partners. Before we dive into our conversation, just a reminder to our viewers that the views and the forecasts expressed are solely those of Jonathan and his team at Meridian based on the research. Jonathan, great to have you on the show. We started off the week, a holiday shortened week for American traders, with a bit of headline drama that the market finally could not look past, and now we're looking past it. It's sort of framed the past couple days of volatility for me and what it tells you about where we are and where we may be headed.
Yeah, real interesting times that are going on here, right? So we were coming off this long weekend, and let's go back prior to the weekend. All the headlines heading into Friday, we're talking about Iran and conflict going on there, U.S. interaction. We're getting headlines that we're maneuvering troops, we're maneuvering ships and planes, and some unconfirmed headlines that Iran was going to get attacked. Attack was imminent. That happened on Friday, and in my mind, I'm thinking, okay, President Trump is waiting for the markets to close. Sometimes he times that out, where especially on a 3-day weekend here, well, it gives everybody time to digest what's going on. Once Friday closing bell came, we heard no more headlines about Iran at all. And then over the weekend, we start getting this Greenland headlines again, and the momentum that powered through Sunday and Monday into our opening trading session on Tuesday of how the U.S. was going to use force to take Greenland, was going to flat out purchase it, was going to battle against all NATO countries that don't support this. Serious implications, and we saw that trend follow through into our markets on Tuesday. Markets got hit pretty good, pretty solid. I didn't feel or see any real panic into that. It was more of that was just the catalyst of the day that caused the sell-off of the market as we've trended higher and higher. Very quickly, the markets rebounded from that with additional headlines coming out of Davos about what is the true plan with Greenland. We don't have all the information. We have very small bits and pieces of information, but it seems like it's coming to some sort of agreement where the U.S. will have some type of land grab in Greenland where NATO and everyone is okay with that. So very quickly our markets rebounded yesterday, and the thing I wanted to see heading into the close was that rebound going to be sustainable, right? Were investors going to really believe it? We did see buying into the close yesterday, and now translate that into the overnight activity that we've seen coming back into today. As we can see today, clearly in the early session so far, the market is still liking the headlines that we're seeing coming out of Davos. We need to continue this trend here, which to me seems like that's the direction that we're going.
So we've had this whipsaw action in equities based off of these headlines. When you take a look at measures of volatility when all this was happening, what is that telling you, and where the volatility is right now, what that could be telling us about going forward?
Yeah, so I like to follow the VIX, and we saw clearly a high spike in the VIX heading into Tuesday's trading session. If you kind of go back and look a bit back in October, we had a spike in VIX. That's when we were battling with tariffs and negotiating back and forth. In November, we had another spike in the VIX above 20 again when discussing the Fed and interest rates and what they're going to do and how they're going to do it. And now clearly we saw this on Tuesday, another spike way up to high 21, 22 in the VIX, but very quickly it came back down. I like to watch this. I'll make it wide, this 12 to 18 band in the VIX. Anytime we get above that or below that, I start to get a little worried. But clearly we saw yesterday the VIX trend back down. We're seeing it again. We're seeing it again today. We're getting back into an area where I think the quote unquote fear in the market has subsided for the time being.
All right, and Jonathan, let's talk a little bit on that volatility noise, because we know that earnings season, we're going to get into the thick of it. Next week we've got the Mag 7s, or not all of them, but we've got the major ones reporting next week coming into it. So in terms of with the earnings that are coming out, do you think that investors or the market's really going to pick up on the numbers themselves, or is it really going to be about the path forward and the uncertainty that they'll be more focused on?
Yeah. Fortunately or unfortunately, however you look at it, I think fortunately for companies, they can use this timing as somewhat of an excuse, right, to kind of go back to their blueprint and say, global uncertainty, geopolitical risks, all the key terms that are out there. They can use that to kind of pause any real true forecast moving forward. As investors, obviously, we want to hear more information and get better guidance and clarity, really drill down to what we're going to see. Earnings season historically has helped our markets. I think we're going to continue to see our normal pattern of companies hits and misses, mostly all to the hit side, and that's what we're looking for. And forecast moving forward again, we're getting to this strange timing of certain things, right? We've got the Fed next week, and all indications are that they're going to pause on interest rates. Go back a few quarters, everyone was using that as an excuse of we're waiting to see what the Fed is going to do when they're going to start cutting interest rates. So we've gone through that, a couple of increments of that, and now it's we'll hear from CEOs and CFOs about the Fed pausing rates. We still have our geopolitical risks and concern. Again, today's Thursday. We haven't heard any real major headlines out of Iran, right? So we're 5-6 days out of attack is imminent to no real information as of yet. So that's died down. I think we're going to hear some more information there. We see these Gaza plans that are going on. We continue to hear the headlines about Ukraine. China, Taiwan is a headline that pops up and then goes away very quickly. That's one that's sneaking around in the background that I think can certainly have an effect on our markets. So kind of stepping back and looking back again at earnings season, I think put all of this together, I think positive views coming out of earnings season, but I think we're going to get that wait and see, uncertainty approach from our forecast reports.
Yeah, and let's actually talk about the Fed, because you just brought it up a moment ago. So we know that's the first meeting of the year that's going to kick off next week. We've got some data that's come in so far. GDP released this morning. I think PC is probably out by now. And, again, that's the Fed's preferred gauge of inflation to really balance those two things, the labor and inflation. So when the Fed comes out, and as you mentioned, Jonathan, market's really not expecting them to make a move on the rates on this meeting. I think we're still priced in maybe 1 or 2 cuts. What do you think is going to be the main focus on the statement next week? Is it going to be more about balancing that labor, or is inflation, or is there this reshuffle? And they've got the subpoena as well, Jerome Powell. Is there going to be talks about that that's going to take more focus and center stage?
I think what we want to hear is why, right? They're going to pause. I want to know why they're pausing. I'm not saying that I agree or disagree with that, but I think getting some insight behind, why they're pivoting at this point. You can make an argument either way that pausing now is the right time or is the wrong time, but I think that indication, I think, is going to be important for us. If we don't get a true explanation as to the why, I think that's going to have a negative impact on our markets. Clearly, economic data has been getting better, but again, with the Fed, no different than a CEO reporting on their earnings reports, the Fed is going to use this as an opportunity to kind of hide behind those headlines, and those headlines are accurate. The uncertainty of geopolitical risks that's out there, right? The uncertainty on our economy and how the impact of both interest rates coming down. It's going to take some time for us to see the impact of that. We talk about the impact of tariffs on our economy. The impact of that takes time. So I think the Fed's going to use all these different things as an excuse, and rightfully so, to pause. But we need that explanation. Like we need to kind of hear behind the screen what was the thought process to get to where we are. We know we're going to get dissenters who are going to want an additional quarter basis point cut. But I think a little information as to what's going on there. As far as the subpoena is concerned, we're not going to hear about that. We'll probably get a few questions on that, and Chairman Powell is very adept at sidestepping those types of questions, and he's going to sidestep his relationship with the White House and the outlook on that. So again, getting back to it, it's the why are they pausing at this point. If we don't get that information or get some insight into that, I think it's going to have a negative impact on our markets.
Yeah, that kind of information obviously can give a nice signal to the markets. When I think about the markets as a forward-looking instrument, Jonathan, right now, is the stock market telling the same story as the bond market? And if they're not, who do you think's got it right?
Yeah, I think there is certainly a disconnect that's there. I think the stock market is giving us a picture that the economy has gotten stronger and is going to continue on that trend. The stock market's giving us some insight as to U.S. corporations, how they're able to adjust and adapt into this interest rate environment that we're seeing now, and we're starting to see some companies make some changes and switches as far as tariffs is concerned. When talking with the bond market, interest rates spiked up over a very long period of time. Little by little, they're starting to come back. They're not coming back down as fast as investors would want, but that's going to be a very long, measured, stepped process that we're seeing there. I think the disconnect that we're seeing between the bond market and the equity markets is the equity markets are reacting rather quickly to what's going on in the headlines that are out there. I think the bond market is somewhat delayed in showing us their reaction or that reaction from within the bond market. So it's going to take time there for them to get in sync, if they can get in sync at all, considering all the different economic and geopolitical factors that are out there and constantly being thrown at us.
And Jonathan, let's talk about the equity markets for a second as well, because it's evident, of course, this year that we've seen a broadening happening as well across the equity markets. It's not just about the Mag 7s anymore. It's we're seeing rotations within sectors as well, and not just between them. So, what does this tell you about how selective investors are becoming?
Yeah, I think investors are certainly getting selective. If you look within the tech sector and we talk about AI and chips and how that's playing into our overall economy, right? The headlines that we followed for quite some time was NVIDIA and the rush to get into NVIDIA. I think it took time for investors to understand that NVIDIA wasn't only the player in town, that there were some other players out there, AMD, Intel, that can certainly compete and be a force within that area there. So I think investors started to realize that they don't have to start chasing these, certain individual stocks that might be in the spotlight, the bullseye, in the headline, and they could start looking to see if there's other ones that can compete at that level there. So we have seen that rotation within sectors, and then outside of sectors, clearly we've seen when the market goes up, everybody, live by the sword, die by the sword. They run right into those tech stocks, but those are the ones that are gonna fall rather quickly when the market does in fact turn, and we saw that earlier in this week. But rotations into financials have certainly have had their day within the last 6 to 9 months, and I think we're going to continue to see that. And I think investors are starting to look for more safe haven places to invest their money, both in equities and outside of equities. Within equities, they're looking for that higher dividend stocks. Outside of equities, we continue to see money continue to roll into the commodities like silver and gold.
Jonathan, when I think about the equity market moves we've seen since we got shaken up in the beginning of the week, and we're building on it today, the S&P 500, NASDAQ 100 up about 1/3%. The Russell 2000 is up about 3/4%. It's it's outpacing the broader market. The small caps have become a very interesting space. Are they telling us things about what they're expecting from rates and the economy and growth?
Yeah, I think so. Like if you go back over the past couple of years, there's been this disconnect between the small caps and the larger indices, right? It's just we were hitting all-time highs in S&P and NASDAQ, and it took a real long time for the Russell to really catch up to that. I think in this lower interest rate environment that we're starting to see, that's the small caps is the sector that will benefit the most from it. Everyone will benefit from it, but I think that's the one that benefits the most from it due to their exposure to leverage and debt. So that being said, we've seen the Russell somewhat outpace some of the other indices that are out there, and they are also somewhat insulated when we start to see some market volatility. So we saw on the downside on Tuesday when markets were down close to 2%. The RTY was down close to only 1%, a little bit more than that. And now on the upside here, it seems like they're participating a little more than some of the others are participating. So again, we've got investors who have been so focused on the big top names in the S&P and the Mag 7 names, and kind of have forgotten about some of these small caps that are out there. Now that the Russell has caught up and is starting to trade a little bit more in line with some of the larger indices, it's become a little bit more popular with investors.
And Jonathan, let's come back to the headlines, because at this point the market's not going to be surprised. We know Iran's an overhang. It's imminent, as you said. The invasion when that happens, or the military intervention, I should say. China, Taiwan, Ukraine, Russia. That's still being worked out there. So how much risk do you think the markets are already pricing in, and is there anything that's still left on the table that we still might get a knee-jerk reaction and still have some downside pressures?
Yeah, I think any of those situations that you just mentioned, plus any of the unknowns that President Trump can tweet out in the middle of the night is going to can certainly have an impact on our markets. But I kind of look at it as a 2 steps forward, 1 step back approach, right? Our markets have trended higher and higher, and when they do, you guys, everyone talks about, what's going to be that catalyst to force investors to sell. Sometimes there is no catalyst, right? Sometimes we kind of make one up. Go back to this weekend, the headlines about Greenland. I didn't feel that was such a market-moving headline, but with nothing else that was really out there triggering our market, that's the one that we all focused on and traded off of, right? So I think we're going to continue to get headlines, and some are going to be good and some are going to be bad. But the market has seemed, to me, feels like it can really absorb some of these negative headlines rather quickly. We are going to start to see some pullbacks every once in a while, these 1%, 2% days. But if the market can bounce back like we're seeing yesterday and today, it just tells me how strong this market is, how strong the economy is, and how we can absorb this type of stuff. So those headlines that you mentioned, they are still out there. We're going to get additional information out of there. We're still watching what's happening in Davos. We've got our normal economic calendar and our earnings season coming up. The 10% interest rates on credit cards, how's that going to affect the financials, and how is that going to play out for creditors, for lenders, and for investors? We still have time for that. And then our geopolitical risks, it's going to pivot 10 times in the next couple of weeks. It's just a question of, do you have the stomach to hold on to this and kind of trade through it? Yes, we saw down 2% markets on Tuesday. If you were able to put your head on the pillow at the end of Tuesday night and thinking as a long-term investor that we've seen these types of things before, you made the right call. I don't think panic selling in any of this is going to be smart, because when President Trump does his interviews, he clearly talks about the stock market. He talks about where it's trading at and the impact of the headlines. Obviously, very tied into and very keen on his impact on the markets. So when you see what happened on Tuesday, I'm sure he wasn't happy about that. I'm sure they huddled in on their way to Davos and said, "Hey, listen, we need to kind of calm the tide here," and they came up with some plan collectively with NATO to move forward on this Greenland thing. We saw the way that the market reacted to that. So I wouldn't get so tied into these swings that we're seeing, because these negative swings can get corrected very quickly. And if you're trying to time it, if you're trying to be on the right side of it, it's very difficult.
Jonathan, we haven't talked much about the metals complex. We were talking earlier about, conflicting signals from bonds and equities. Then I think about gold hitting new highs on days when equities are hitting new highs. There's things I learned a long time ago that just don't seem to hold water. At what point in this run in gold as a safe haven play could that actually start to weigh on equities?
Yeah, some of this stuff doesn't make sense, right? We're taught, we're taught about inverse relations in asset classes and in indices, but we're not seeing that. We're not seeing at this point right now. As gold continues to trend higher, there's a couple of factors there. One is the FOMO of missing out on this gold trade, if you want to call that. I also think that when investors look at gold and when they look at silver, they categorize it differently than a stock, right? Than an equity, and they look at it as this hard asset. We can discuss about mining and limited availability, but from a hard asset point of view, that's always going to be a portion of somebody's portfolio in some way or another, whether you own the hard asset of gold or whether you own the gold ETF or a miner. That's always going to be part of it. At this point, I don't see a headline that's going to derail this gold and silver rally. Think about the multiples of headlines that we've heard over the last 4, 5, 6 months. Some very good, some rather bad, and gold has not wavered at all. So that leads me to think that this gold run, this gold rush, is going to continue higher.
Jonathan, great insights today. Thanks so much for joining us. I really enjoyed the conversation. Look forward to doing it again.
Thanks for your time. Have a great day.
You too, Jonathan. Jonathan Corpina, Senior Managing Partner with Meridian Equity Partners. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered advice or buy, sell, or hold recommendations when you're investing. Hearing lots of interesting stuff there. I like when he said, often, and humans will do this, right? You got markets at or near all-time highs. We look for the selling catalyst. And he said, sometimes we just make them up. And he feels that earlier this week, we just decided the Greenland would be the thing that we'd make up, not really economically meaningful for the actual underlying fundamentals of the markets.
Yeah, absolutely, Greg. What I picked up was 2 steps forward, 1 step backwards, right? So that really speaks to it. I think at this point, you've seen the market really react to this news initially, and then it's almost like whenever we've had this reaction, it's seen as a buy the dip moment. We've seen the markets kind of reversed, as we saw evidenced by yesterday when he turned back on the whole Greenland deal. I mean, they have formed some sort of structure with the NATO. There's constructive talks happening on that front. So I think more of it is it's just about the administration taking out the knives and just sharpening them up, and just seeing what the reaction is, and that's what the market's kind of getting used to. One thing other that Jonathan also mentioned was when it comes to the earnings plays, technology, we are seeing that kind of broaden out within the technology space as well. But keep in mind that the IT sector still is the growth driver for earnings, especially for this year. BlackRock still, came out with a note and said they expect just about 20% earnings growth that's solely going to be dedicated to IT, to the information technology sector. But it just really depends whether it's going to come from the Mag 7 and how much of that is going to be contributed from those from the Mag 7, and maybe by the end of the year it's going to be like the Fab 4. Who knows what it's going to be? So we'll see what's on the other side of it.
Definitely a lot to chew on in that discussion. Worth a rewatch, I think, after the show is done. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. You just open a practice account, you click on Try TD Active Trader, that button right there. Then when you're ready to switch to a live account, simply export your workspace, start trading for real. Now, for a more technical take on what's happening out there in the markets here, and you're taking a closer look at big tech. You got the triple Qs on the screen for us, I believe.
Yeah, I've got the actual index itself, Greg. So we're looking at NDX that we've got. So this is the Nasdaq 100 index itself, and we saw a major reversal happen yesterday. You know, this was we saw the index really move into more risk-on mode. This is on the news that President Trump has canceled the planned tariffs on NATO members, and they've also announced a future framework for a deal on Greenland. So that really got the markets buoyed up. So we're back on risk on sort of trading. We've seen short-term pricing reflect that as well. Now remember, the Nasdaq 100 rally does tilt, the probabilities of retesting those year-to-date highs, which is around that 26,000 level. So that's kind of where we're going to next, and I'll show that up in the moment. But I think the big catalyst that's going to really shake it up is what's coming around for next week. We're into Q4 earnings for the tech companies. So Magnificent Seven names: Meta, Microsoft, Tesla, Apple. They're all on the docket for reporting. And the other eye to it, aside from this, we haven't talked about it a lot, but there's a little sort of fiscal crisis that may be starting to brew in Japan, and what that could mean for a potential like unwind 2.0 kind of trade. So I think there'll be in one ear to that and one ear to the earnings that we want to look at. That's going to really shape it up for the tech space. But let's turn to the charts and really show what's the play out is. So I've got the daily chart pulled up on the NDX, and here you can just see we've started since the summer. We've gone into this sort of bullish rally channel, but ever since we kind of broke this 24,000 support, we've kind of had a retest on that support, once towards the end of the year, and then we had a big bounce up where we did hit sort of an all-time high on the Nasdaq, this 26,250, this elusive number. I have marked this 26,000 as kind of the line in the sand. This is where you're going to have to see a lot of, catalyst. Maybe it could be the earnings that would really push it up there. But we've seen multiple times rejected. It rejected off here. It wasn't able to have a close above and confirmation. So we want to see consecutive closes above this line. Rejection over here, rejection over here. And what this is forming, Greg, you can see this telltale sign. We've got this lower higher lows forming, I should say. There we go. Higher lows. And we've got sort of this rejection happening, and this is forming what's known as an ascending triangle in our technical world. And really, this is a bullish reversal pattern. We do want to see the break to the top side, and so it really has to crack this 26,000. We could see the next leg up here. On the downside, the risk is going to still be, closer to this 150-day moving average, which is just sitting above that 24,000 level. That's going to be a really meaningful correction if we do get there. But I do see it just kind of bouncing off. It's also respected the lower bounds at this point. So that's kind of where we're heading. We should see a little bit of crunch. I don't see volatility picking up a whole lot. Hopefully grinding is the way I would describe it, on its way up to the 26,000, possibly looking to break that barrier there.
All right, interesting work there on the NASDAQ. How about Seagate Technology Holdings? What are you seeing in this one?
Yeah, let's talk about Seagate Technology. So STX is the symbol. This is, they're in the memory business or the data storage business. This has been a boom and bust business, and it's seen the biggest boom in years. That's perhaps that's happening right now. We've seen this. The catalyst is the rapid, build out of infrastructure for AI. It's consuming a large portion of available supply of this flash memory, what's called as NAND, N-A-N-D, and DRAM memory, but also hard drives. Remember, when we think about the cloud, they're still, anchored in actual physical storage and location, right, Greg? And that means you've got to have hard drives at the center of it. And so really what the story is you got really tight supply that's driving up prices, but it's also buoying up these data storage players, and Seagate being one of them. So remember, Seagate's a global manufacturer. It does a broad range of storage systems, and including hard drives. They do solid-state drives, and they do hybrid storage devices, integrated storage that's aimed at enterprise, cloud, and consumer markets there. They have their earnings coming out next week on January 27th after the market closes. Expectation, this is their Q2 26 earnings, $2.55 EPS, which is going to mark a 40% increase year over year. So really being buoyed up. And on the revenue side, 2.7 billion is what they're expecting. That's about 16% year over year. So really extracting a lot of margins out of that revenue, especially on the EPS. Full year expectations are about $10.40 for 2026. That's going to mark a 43% increase year over year that we have. Data centers is the big one to keep an eye on that investors will look at. Right now, it accounts for 80% of Seagate's total revenue, and in Q1, that reached 2.1 billion in revenue. That was a 34% year-over-year rise. So really, investors will be looking to zero in on those cloud order trends, pricing dynamics that are there, and any margin updates, along with hints that if customers are going to be trimming inventories, especially with this CapEx cycle and whether they're kind of buckling under the pressure. So any slight change in those messaging on those fronts will hit the stock hard. But if we look at the stock itself, Greg, I'm going to bring up the chart on Seagate here now. What we have is a very strong bullish trend. I'm just going to show where the stock was just about, going back to April. We hit the lows in $80. It resumed the strong bullish upward trend that we see. It's been very well respected. You can see this blue line that I have here. This is the 50-day exponential moving average. The yellow is the 21-day moving average. It's pretty much stayed on top of that 50-day throughout this whole period. So this is being seen as a key. If you want to think of it as a dynamic support, the 50-day is a stronghold. The price has come down. We've seen volatility tick up by these, as evidenced by these larger candles. So we do see the 50-day as kind of the support area, the key support area. But looking at some of the other areas or levels that I'm looking at, we've got 310 right now. So the stock's trading about 340. I do see it started this short-term upward sharp trend over here. If it does do a pullback on this earnings, I could see it test 310. If it's really bad, then we could probably come down to the 50-day, which is at that 287 level, which is where I marked the support at the 275. So long-term bullish trend really intact. The other two lines that I've got here, Greg, I just wanted to see the standard deviation move. So we've got a regression standard deviation channel marked up here. These purple sort of bands on either side, that's a one standard deviation move. That's the top side reaction where it's been moving. And then these dotted lines on either side, that's a two standard deviation move. So that really gives us sort of conditions or drivers where we think the price could go. The one other thing that I will show that I wanted to just indicate, because we are in price discovery zone and we're going to do this live on the show, Greg, we're going to draw Fibonacci extensions over here. And what we want to see with extensions is essentially...
Spoiling me.
We're going to try and predict where the prices could go. So we look at the highs, we look at where it retraced to on its most recent retracement down, and that really paints us a picture where the extensions could go. We could see the 356 level. The key extension levels are going to be the 1.382 and 1.618. So if it does come out with its earnings and market's expecting a $50 move, it's going to test this close to this 405 level here, Greg.
Now, it'd be a shame to leave that chart with all the work you've done on it without walking through a couple ways someone could trade Seagate technology. Before we get started on that, just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. All right, I think you had a bull channel there, so why don't we start with a bull strategy?
Yeah, let's go with a bullish strategy, Greg. All right, so we've got the bullish option trade opened here. I don't want to do a big reveal just yet, so we'll wait for that. So what I've got here is if you are expecting, the thesis or the backdrop to still hold up, demand's very strong, supply's tight, and the market's kind of, if we look at the market expectation coming to this earnings print, we've got about, from the implied volatility standpoint, it's sitting in the 80th percentile, very high implied volatility, and expected market move is just shy of the $50, sitting at about $48 at the moment there. So one trade you could do is, you would typically do a bull spread, but why not? Why just have one when you can have two? So we're going to do what's known as a double bull spread, Greg. This is what I would probably call like a YOLO trade or a high conviction trade, if I'm being more formal with it. So here's what we're really looking for. When I say high conviction, it is very much directional, and we're looking for a big move to the top side. So what we're looking to do as part of this trade, it's comprised of a bull call spread. So we're looking to play the upside, so buying a 350 call, which is just slightly out of the money based on the current price of Seagate. And then we're looking to see where we think the next level of resistance could be based on where we think when you look at the two standard deviation move, which kind of lines up in this 385 to 390 zone. So sell the 390 call above it. We are going 40 points wide on this spread. And we remember, because this IV percentile is high, and this is the rationale with why I'm doing it this way, is that the options are going to be expensive. So now we want to further sell another credit spread. So in this case, we're doing a bull put spread to the downside. We're selling the 290 over here, and we're buying the 250 again. We're keeping the distance the same, $40 wide spread, and we're collecting a little bit more premium. And that what that means is it improves our overall cost for this trade. So our debit on this trade, in fact, I'm going to just do a little bit of a reveal. It's over here. It's $6. So we're spending $6 overall to put this on. So that means our break even's at 356. And so it's directional. So I need the stock to go up. I need it to go at least to 356. A lower break even means we improve our profitability percentage here. But max situation is we get to the 390, and I can do the reveal on that one, Greg, for you.
Roll it down, give it to us.
Let's do the roll down. Okay, let's wind it up, and they're crossing into each other. All right, so here's what we have. So in the max profit story, it is going to be really, if it does play out the way we want it to, 390 gets up to that price. We take the distance of the width, so $40 minus what we're paying for it, $6. We're going to make $34 on a single contract. In other words, that translates to $3,400. But here's where it gets hairy if the trade doesn't go the way we want it to go. So we do have a buffer zone. So obviously, if the stock remains below 350, we are first going to lose the $6 we paid for it. But then that's not the end of the story. Typically, if you just stop there, you would lose the debit. But because we've sold a credit spread, we now present more risk to ourselves. If it continues to fall and gets into the 290 area and below, we start losing more. The max loss that we could face is Seagate coming down to 250. That means we're going to be wiped out $40 over here. This is why I say it's a high conviction trade. So $40 translates to $4,000. But remember, we also paid the $6 up here. So in total, it would be $4,600 if it hits the 250 price level there.
All right, so important things to consider in that high conviction trade. What if you don't have that conviction? You want to go the other way. How could a bear play it?
Yeah, let's look at the bearish trade. So let's flip the script over here. I'll queue up these charts. Let's roll it up here. So again, we've got the same profile, 80th percentile profile. If you want to directionally play this, especially with the volatility, and if they do have a slight hint that they're not going to be, the demand's kind of waning, or the supplies, they're not going to be able to meet that demand with the supply, then we could see the stock sell off here meaningfully down into that 50 EMA level over here. So one way you could do this is, again, we're going to put spreads on, Greg. In this trade, we're going to do a long put condor, and what this is comprised of is essentially a debit put spread and a credit put spread here. So here's how it works. We're looking to buy the 335 to the downside. We're going to look to sell the 305 to take in some more premium to reduce our cost. And again, the reason we're doing it, it comes back to the percentile. These are going to be expensive options coming into earnings. So we want to further see if we can reduce our cost, and we're going to sell a credit put spread, sell the 285 strike, buy the 255 over here. Now, this overall costs us, the debit trade is going to be $7 is what it's going to cost us. And the way you think about a break even is because directionally we want the stock to go down. We need to get it to our break even price. So it's just our long strike of 335 minus what we paid, $7. That puts us at 328. So we need Seagate to at least come to 328 for us to start being profitable on this trade. And I think I can do the queue up and the roll here.
Yeah, show us the reveal. What are we putting at stake here?
All right. So here's the max gain story. So if it gets to 305, of course, that means with a 30-point wide spread minus what we're paying for it, which is $7, we're going to be making $23. This should be $23, Greg. I got the math wrong here. But $23 or $2,300. And on the loss side of it, it's just going to be the debit that we paid. So even if the stock goes down, even in this credit spread zone, remember, we're already making money here fully, and we're going to be losing, so it kind of nets each other out. So we just end up still losing what we paid initially, which is the $7. In other words, $700 is going to be our max loss on this trade there.
All right, interesting possible strategies for our audience to dig into. That is the show for this week. As always, investors should perform their own due diligence before engaging in trading. We will be back next Tuesday. And what's the debate topic for next Tuesday?
We are doing, I believe it's Google. I might be off of my
No, Chevron.
my calendar. Oh, Chevron. Yes, we're back with energy companies. Chevron's obviously been in the news headlines in recent weeks, so we're going to be putting them to the test and seeing how they've been faring through all of this, through these headlines.
We had a brain swap. Usually I'm the guy who has no idea even the day before the show.
Yeah, I did. It's been one of those days. Yeah, obviously I got my max gain wrong, and I got I'm moving ahead of time. Maybe I did a reveal ahead of time, but it is Chevron squarely, and it won't be my usual fare that I'll be going up against. I think we've got Brian back in the seat for next week's show, so that'll be interesting, and we'll see who decides which side each of us takes.
Always fun to have Brian Rogers with us. Going to be a great show. Thanks for watching this one. And when it comes to Active Trader Live, we'll see you on Tuesday. I'll just see you in a couple hours' time for Money Talk Live.